So this week we are looking at average clause. This is the end of our chapter on insurance. So average clause applies in the case of underinsurance and partial loss. It's based on the principle of indemnity. So let's go back to the principle of indemnity. Right up to the top we looked at our 5 principles, and indemnity I believe was up here. So indemnity is the insured person should not profit from insurance. So insurance basically just exists to cover any losses you'd have, and you're not allowed to make a profit from it because they're set up in a case to uh, just cover your losses, and obviously they couldn't operate as a profit-making company for you. Um, so that's kind of a principle behind it. I'll get to that in a second. But what we're looking at now is average clause, and it covers people in the case of underinsurance or partial loss. So let's look a little deeper into it. So what does underinsurance mean? Underinsurance means the insured item has not been insured for its full replacement value. Again, what does that mean? I'm just going to go straight to an example just to show you. So what we're looking at here is that the insured item has not been insured for its full value. So I'm going to go full screen on this. And we'll look at it here. So a house was flooded and partially damaged. So you have a house, it's flooded and it's partially damaged. You know, maybe the kitchen is destroyed, but the rest of the house is okay. Upstairs is perfectly fine. You know, it's just the kitchen. Maybe in this case a bit more. The actual value of the house is 250 grand. So your house is worth $250,000, but it's only insured for 200 grand. So even though you know your house is worth 250 grand, you've only bothered to insure it for 200,000, and the owners are claiming 20,000 damage or 20,000 compensation for the damage. So what's happened here is there's a house, the kitchen is flooded, and the owners think there's about 20,000 euro worth of damage. So they're trying to get a full 20,000 euro. Their house is not completely destroyed. It's worth 250. There's 20,000 euro damage. So what we're looking at here is we're looking at a case where there's only partial damage to a house. So how much money should they get back if they claim there's 20,000 euro damage? But the big thing we're looking at is their house is worth 250,000, but they haven't insured the full house. They've insured 200,000 euro out of their 250,000. So if you think of it, right, if you owned a car and the car was worth 20,000 euro, you know, legally by law you have to insure the full value of the car. But let's say you could only insure half the value of the car. Now if your car is destroyed, you're only entitled to half of the damage. Why? Because you've only insured half of your car. So when that half gets destroyed, the insurance company will pay it. But when the other half gets destroyed, you're out on your own because you haven't that half covered with insurance. So in this case, this is a full house. It's worth 250,000. You've only insured 200,000 euro worth of it. There's 20,000 damage. So this is a complicated example where we're looking at a real life example of a flood coming in, destroying a kitchen, and how much money will this family get back? So how much compensation will be paid to the owners? And there's a formula for it. And this is the formula. It's always the same. So the formula is the insured value. The insured value. So what's the value of what you have insured? So you have insured it for 200,000 euro. So that's your insured value. And we divide that by the actual value. What's the actual value of the house? And then we multiply it by the amount claimed. So the amount of money that you're claiming. Insured value is how much you're insuring the house for. Actual value, how much the house is worth. Amount claimed, how much money you're trying to get for damages. That's all you have to remember. That's how you calculate insurance compensation when you have partially insured something. And this whole thing is called average clause. And why we have it is since the homeowner has insured their property for only 4/5 of its replacement value, because we've insured 200,000 over 250,000, we've essentially insured 4/5, 80% of the house. You're only entitled to 80% of any loss. They haven't insured the full house, only 4/5 of it. You know, 4/5 is in like if they had insured full amount, 5/5, they've insured this for 250, but they haven't. It's 200. So they've only insured 80% of the house. They're only entitled to 80% of the damages. Now, this is what we're looking at. So this is the insured value. This is the actual amount of the house, and this is the damages. This is the amount of money they want, but they're not going to get it all. Because the insurance company said, do you know what? You've only insured basically 200,000 euro worth of your 250,000 euro house, which is, 80% of it. You don't need to calculate that, but that's what it is. So you're only entitled to 80% of the damages. This is how we do it. The damages are 20,000 euro, and you're only entitled to 16,000 euro damage. So that's the example. It might look a little bit complicated. So what I'm going to do is I'm going to go through a separate example here. So remember, the formula is your compensation. Compensation is equal to the insured value divided by the actual value multiplied by the amount claimed. So that's the formula again, you see it up here. Let's go through a different example. Let's just say that you have a house, and that house is worth, sorry, my keyboard is not corresponding. Your house is worth 1 million. So that's the value of your house. It's worth 1 million. That's quite a expensive house to insure. So you decide when you're getting your insurance, you're only going to insure 600,000 euro worth of the house. So it's worth 1 million, but you're like, do you know what? That's going to be very expensive in order to pay the insurance fees every single week for the value of that house. I'm going to insure the value for 600,000 worth of that house. You've basically insured 6/10 of the value of your own house. So what happens if there's a flood? Again, my keyboard isn't working. Okay, so you're gonna have to obviously, sometimes the letters don't click in. So there's a flood. I'm just going to say F for flood. There's a flood, and now you've insured your house for 600,000 worth of a $1 million house, and we have damages of 20,000 euro. So the flood, F for flood, has caused 20,000 euro worth of damages. So how do we calculate how much money they can claim back? Let's look at it again. How much is the insured value? This is the value of the house. This is how much we've insured it for. And this is the damages. This is the amount that we're trying to claim. We're trying to get the full 20,000. Let's just say 200,000. So let's look at the formula. Insured value. The insured value here is the 600,000. So the 600,000. I'm going to divide that. Divide it by the actual value. Actual value of the house is 1 million. And what am I going to do then? I'm going to multiply it by the amount claimed. And I'm claiming, because of the flood, I'm claiming 200,000 euro worth of damages. So multiplying it by 200,000, and that's going to be equal to whatever it is here. So 6/10 of 200,000, 120,000. So that's our answer here. That's the amount we'll actually get. There's been 200,000 euro worth of damage to our house. We've insured 6/10 of our house. The house is worth 1 million, insured it for 600,000. So we're going to receive 120,000. Even though there's 200,000 euro worth of damage to my house, it's completely destroyed. I'm only going to receive 120,000 euro worth because I didn't insure the house in full. I can never receive the full amount. So that's average clause. Again, if you want to go back and watch what I've done, the videos there, so you can go back and rewatch it. Sometimes it can be a little bit confusing from the start, but I've shown two examples. You have your example here in your PowerPoint, and I've just gone through this example here. Again, all you need to do is look at the formula. Insured value, how much you insured the house for, divided by the actual value, how much the house is worth, multiply it by the amount you claim in damages. And what that will find you is the amount that you'll actually get from the insurance company, the amount that you can claim for, how much compensation will be paid out. So back to our slides. Reviewing an insurance policy, just a couple of things left. So insurers will send a renewal notice when your policy is due for renewal. At that time, it is worth shopping around for a new deal. So what's happening here, obviously, is that if I insure my house, car is an easier one because most of you will get car insurance in the next couple of years. Um, when you're getting your insurance, you get your insurance for 1 year generally. When your year is nearly up, you'll get a renewal notice from, let's say, Aviva. Um, I've got insurance. My insurance is with Liberty. So when my year is nearly up, I'll get contacted by Liberty Insurance to say that my insurance is nearly out, and it's up for renewal. And every single year, I will ring around, I will look online, I will try to see can I get a better deal. A couple of years ago, I was with Aviva, and then Aviva didn't. They were the best deal at the time, and then I found Liberty were a better deal. So you shop around. Basically, you're looking for a new deal. So this is what happens when you're renewing an insurance policy. You'll get familiar with it when the time comes. Couple of slides left. What are the benefits of insurance? So obviously the compensation received allows policyholders to replace or repair items that have been damaged or stolen. Who are the policyholders? You are the policyholder. So you are the person who takes out insurance for your car. If you crash your car, you get compensation. The insurance company give you money. And obviously this is a good thing. That if, in the event of complete damages, the insurance company will give you money so you can replace your car or repair your car. So that's obviously that's a huge advantage to insurance. It obviously costs a lot of money. Obviously, in order to get insurance, there's an obvious financial cost that you're willing to pay. But many are willing to pay it because it protects them from financial uncertainty or loss. If you have a house and all of your life savings gone into buying that house, it's a ridiculous risk sometimes to take, in the hope that if never getting insurance and just hoping that nothing happens to your house, because if it does, then you're in trouble. So that's where insurance comes in. At least if all your life savings have gone into buying a house, at least if you have insurance, you know that at the end of the day, if something happens, you can get your money back. You can get your money back from the insurance company. Other forms of benefits are salary protection. We've gone through that in the previous video, and a critical illness cover. In the event that you uncover a critical illness and you're not able to work, salary, so your wages can have protection. That's a certain type of insurance. Obviously, the more types of cover you have, the more you'll have to pay. And life assurance gives families financial certainty in the event of a sudden death or loss. If the main money earner in a house was to pass on and they've life assurance, the family generally receives quite a bit of money to obviously keep them from financial insecurity. One of the many benefits, one of the main ones being this one here, obviously that you receive compensation. Finally, I think this is the last one. Is insurance really necessary? If you drive, and I think it's the second last one. If you drive a motor car, you are absolutely required by law to have insurance, but there are other types of insurance are optional and may not be necessary. You can see here there's a certain amount of things here. Your car insurance, if you have a car, you have to have car insurance. You do not need life insurance. You do not need home insurance. You definitely don't need travel insurance. A lot of people wouldn't get that. Some people would. But if something happens when you're traveling, you better hope you've travel insurance. If your home gets burnt down or if there's a flood, you better hope you've home insurance. So obviously you don't have to get the other ones here, but if something does happen, it's a lot safer for you to have insurance to cover. Obviously it costs a bit of money, but in the long run it could end up saving you a lot of money and stress. Is it necessary though? It's completely necessary for driving a car because it's required by law. It's illegal to drive without insurance. Last one. Can all risks be insured? Some risks are uninsurable. So no, not everything can be insured. Remember the first thing we looked at is insurable interest. All the way up at the top here, that was one of our first principles. So insurable interest we have all the way here. So to insure something, you must benefit from its existence and suffer financially from its loss. So remember, we gave the example that I can insure my house, but I can't insure the houses across the street. So if the houses across the street get destroyed in a fire, obviously it's not going to help me if I'm trying to sell my house, because the views from my house now are, a housing estate of rubble. But because I didn't suffer financially specifically from their houses burning, I can't get insurance for somebody else's house. It has to be something that I could lose. So that's one of the things we looked at for insurable interest. Um, but there's other things as well. If you're operating as a business, um, some risks are uninsurable. So, for example, because your business closed because of the pandemic, you've made obviously a massive amount of losses. Restaurants are making huge losses. Pubs are making absolutely massive losses. They've been closed practically all year. They cannot get insurance because of a pandemic. They weren't covered. You can't insure against the pandemic. You can't insure against multiple different things out there because there's no real way of knowing how much money you could lose. Um, so some risks are uninsurable in general. It is not possible to insure risk where the insurer cannot work out the chances of a loss occurring. And your example for this is that you can't insure against the pandemic. That's it. That's the end of insurance. Um, what I'm going to get you to do is I want you to take down this slide. So if you take out a pen, and you can obviously pause this now, and I'll call out the slides I want you to take down. Slides 41, 42, 43, 45, and 47. And again, your example here for 47 is the pandemic. Um, so again, I'll just quickly call that out. You're going to take down slides 41 to 43, and then also taking down 45 and 47. That's the end of insurance, and we're starting the next chapter in our next lesson.